Hi everyone, welcome to Ethereum Update. I'm Bob Chow. Today we're going to discuss something very, very important. If you've been paying attention to financial news, you've seen that a lot of different economists and experts are predicting a market crash in the stocks sometime in late 2017 or 2018. Specifically, Jim Rogers has predicted that there will be a market collapse unlike anything we've seen in our lifetimes sometime in 2017 or 2018. I'm not so sure when we will have a market crash. However, I do see that the ingredients or the factors leading up to a market crash are certainly accumulating. And let's take a quick look at some of these charts. Okay, so this is our first chart, and in this first chart we're looking at the S&P 500 index, and as you can see, we've had various ups and downs. So this was the peak, one of the peaks in 2000 before the dot-com crash, and it crashed all the way down to 850 or so. Then it went back up to the 2007 crash, and this was at a peak of 1526, and the S&P 500 dropped all the way down to 735. And now, looking at the S&P 500, since the 2009 crash, we've rallied all the way up to 2,441. So as you can see, there's been a huge, incredible rally for the last 8 years. And, if history is to repeat itself, we are due for some sort of correction, if not in the past where it should have occurred, maybe right here. It seems as though we are building up to a future crash or a future correction. This is the S&P 500 PE ratio, where we are currently at around 25 or so. And, the average PE ratio across time has been around 20 or so. So right now we are at 25, which is a bit overpriced compared to the historical PE ratio. And as you guys know, the PE ratio is a ratio of price over earnings. So as the PE ratio increases, you are paying more for each dollar of earnings that a company is producing. So that's why we say that a high PE ratio generally indicates a more overvalued stock, because you are paying more for each dollar of earnings that the company is producing. Now, if you look right here in 2009, the PE ratio spiked to 86 actually. But I just want to let you know that even though the PE ratio is at 86 around the 2009-2010 level, that PE ratio should be generally discounted or ignored because at that time earnings were particularly low during the 2009 crash. Therefore, the PE ratio, the price over earnings, was so high. So in general, if you look at the historical PE ratio, we aren't quite at the 2000 levels. In the 2000 levels, it was around a PE ratio of 45. We are at 25 right now, so we're not quite at the 2000 dot-com valuations, but we are above average compared to the overall market. Looking at another PE ratio, this is the Shiller PE ratio. This gives another picture of the price over earnings. And this price earnings ratio is based on an average inflation adjusted earnings from the past 10 years, also known as cyclically adjusted PE ratio. So in this particular PE ratio, this is the Shiller PE ratio, it's calculated as being 29. So with this particular PE ratio, as you can see, the adjusted PE ratio of 29.86, we're at a pretty high level compared to the historical PE ratios. So, you know what, it's always difficult to predict when a correction will occur, but typically it will occur when there's high PE ratios and when the market has, gone in a bullish direction for a very, very long time, which we have for the past 8 years. I'm not sure I entirely agree with Jim Rogers that a correction is going to occur in the next year or so. However, I do see that all the factors that build up to a correction are present at this present time. Hopefully in the last 8 years or so, you've been invested in the bull market and you've taken advantage of some of the gains in that bull market of the last 8 years. And if you're one of those investors, what I would suggest is taking some of those earnings and reinvesting into some more safe areas. So maybe instead of investing in high-tech stocks, you invest in more safe areas such as pharmaceuticals, energy, tobacco, consumer staples, or some of the more safer consumer discretionary areas. And I've got some suggestions that I'll share later on. In other words, I'm not so sure that I would take my money out of equities, out of stocks, and just put it into pure cash, because whenever I've done that in my own personal experience, the markets continue to go up. So in the past, maybe in 2015, I took out maybe 30% of my investments and put it into cash, but then I saw that the bull market continued for another year and a half. So I wouldn't suggest taking your money out of equities entirely. Rather, I would take it out of the more risky equities, the more risky stocks, and putting them into more safe haven stocks. So let's take a quick look at some of the safe haven stocks that I suggest. I would consider pharmaceuticals more resilient to the economic cycle. I would consider energy also more resilient to the economic cycle, tobacco, consumer staples, precious metals, and also I will also be interested in some safer consumer discretionary companies. With respect to pharmaceuticals, pharmaceuticals still have some specific risks, such as you might know, as the government becomes more and more involved in healthcare costs, they're going to be putting more and more pressure on pharmaceutical companies to lower prices. You know, that's a big political debate that's going on right now. However, I would like to share some of my personal choices in the pharmaceutical field. One is one stock that I'm looking at is AstraZeneca. AstraZeneca recently had a little bit of a struggle as well, so you can buy it at a slight discount from higher prices earlier this year. I'm also looking at CVS, which isn't really a pharmaceutical company. However, it does deal in pharmaceuticals, as you know. With respect to energy, I'm looking at ExxonMobil, for instance. In general, I like to look at companies that have recently gone down just a little bit, just so I can obtain some of the stock at a rebate price. With respect to tobacco, I like MO, which is Altria. With respect to consumer staples, I'm looking at Kellogg and General Mills, K and GIS. With respect to precious metals, in general, I don't really like precious metals as much because I prefer stock equities which pay dividends. So, but I do recognize that some people like precious metals such as gold, and I'm currently invested in some GLD. Also, with respect to consumer discretionary, some of the consumer discretionary that I've bought include Starbucks, which has recently fallen a little bit because of a miss in earnings, as well as I'm currently invested in some Chipotle Mexican Grill as well, CMG. As you guys know, Chipotle is suffering from some E. coli related bad news and bad press, and therefore that stock is way down. However, in my opinion, I still feel as though the long-term outlook for Chipotle is okay because I still see people eating at Chipotle. So these are the areas I'm looking at, and I shared with you some specific stocks that I personally am looking at, but you may decide on different specific stocks. In general, this video is about trying to protect some of your earnings by moving some of your earnings into some safe haven areas that are more resilient to a market downturn. So in general, I like to stay invested in stocks even though there may be a market downturn because, as I said before, you never know whether or not the bull run will continue for another 2 years or so. So I think what I'm doing is I'm hedging my bets. I'm putting my money into less risky assets, and I'm still going to take advantage of the bull run if it continues. And if, on the other hand, the market drops, I'll be insulated against that drop to a large degree. That's kind of my thinking. Please let me know what you're thinking. That being said, I personally still hold some high-risk stocks such as Tesla and Alibaba because I've been holding them for a very long time. And in general, I'm still very optimistic about those particular companies. However, for some of my other stocks that were in technology, I've kind of shifted them into these safer, safe haven areas. I hope this video has been helpful for you guys. If you feel as though this video has been helpful, please feel free to like, comment, and share. Also, as I said before in my previous video, I'm doing a question and answer session in the next video, and I will try to answer any questions that you guys might have about myself if you have questions about me. Thank you so much. Bye.